The market is at a decision point. We have arrived at a moment where the path forward is genuinely uncertain. A powerful tension has been building for weeks, creating a delicate balance that is now set to break one way or the other. This is not about a single data point or one company's report. It is about a confluence of major forces, each with the power to move everything. These forces are pushing and pulling against each other, creating a high-stakes environment where the next major trend could be born. This week could very well dictate the market's direction for the remainder of the year. The primary drivers are clear and potent. On one side, the narrative of artificial intelligence continues to fuel immense optimism. The promise of a technological revolution, led by companies like Nvidia, suggests a new era of productivity and corporate profit growth. This powerful tailwind has lifted indices and created enormous wealth. On the other side, however, persistent inflation concerns and rising treasury yields build a wall of worry. The cost of money is rising, changing the math for investors. Wednesday, August 26th, is not just another trading day. It is shaping up to be the pivotal moment of the entire quarter, a day where three market-moving events collide. Before the opening bell, traders will be hit with a double dose of critical economic data. We will receive the July Personal Consumption Expenditures Price Index, the Federal Reserve's preferred inflation gauge. At the same time, we get the second estimate of Q2 gross domestic product, clarifying recent economic strength. The market cares less about levels than direction, whether inflation is moving the way the Fed wants. A cooler than expected number could open the door to a pause, even eventual cuts, sending yields lower and boosting growth stocks. A hotter print would suggest sticky inflation, pushing yields higher and pressuring valuations. As if that were not enough, the real drama arrives after the close. Nvidia, the bellwether of the AI revolution, reports earnings that have become a referendum on the entire AI thesis. Investors will dissect data center revenue, forward guidance, gross margins, and demand from major cloud clients. The stock's reaction could send shockwaves through technology and the broader market. As the dust settles from Wednesday's data and earnings storm, focus pivots to Jackson Hole, Wyoming. Hosted by the Kansas City Fed, this symposium is where central bankers, economists, and market leaders shape the narrative. This year's spotlight falls on Friday's keynote by Kevin Warsh, a closely watched voice on policy direction. Traders will parse every word, phrase, and nuance for clues about the future path of interest rates. His message can serve as a trial balloon ahead of September's critical meeting. A dovish tilt, confidence in disinflation and growth risks, could cool rising yields and power growth stocks, especially AI. That would validate the idea that growth can coexist with today's economy, unleashing a new wave of Nasdaq buying. A hawkish stance, focus on persistent inflation and restrictive policy, would reinforce higher for longer and pressure valuations. Tighter financial conditions raise discount rates and weigh most on long-duration growth. Warsh's words could define the week's final act. In a week this pivotal, a single tone shift can change everything. Beyond the headline events, earnings and Fed speeches, powerful undercurrents can override the data. Chief among them, geopolitical conflict. Tensions around the Strait of Hormuz threaten a critical choke point for global oil flows. Any hint of disruption can send crude soaring, the market's worst-case inflation scenario. Higher energy costs tax the economy while pushing up inflation metrics the Fed targets. Stagflationary shocks can drive stocks and bonds lower, forcing rapid rotations into energy. Adding complexity, renewed tariff risks between the United States and Canada. Such disputes disrupt planning, squeeze margins, and stoke inflation. Impacts often concentrate by industry, timber, automotive parts, and more. All roads feed back into the tug-of-war. Growth versus treasury yields. Higher yields raise the cost of capital and discount future earnings more heavily. That is why the tech-heavy Nasdaq is so yield-sensitive this week. While Nvidia will capture the spotlight, looking beyond the AI giant gives a fuller read on market health. Other reports act as cross-references, confirming or contradicting the broader narrative. First, MRVL Technology, a critical AI ecosystem player in networking and custom silicon. Its results will help confirm whether Nvidia's AI demand is broad and durable or more concentrated. Next, CrowdStrike, Cybersecurity spend often remains non-discretionary even in uncertainty. Strong growth would imply healthy IT budgets. A slowdown could warn of broader pullbacks. Salesforce offers a window into enterprise software demand and AI product monetization. Outside tech, Dick's Sporting Goods provides a clean read on the U.S. consumer. Sales, inventory, and guidance will show whether rates and inflation are pinching household budgets. Together, these reports map where real strength and weakness lie beneath the indices. The edge goes to investors who synthesize across sectors, not just the headline name. Navigating a week this dense requires a disciplined plan. The key is to react, not predict. Monday, observe positioning. Watch 10-year yields and crude. Avoid large new bets. Tuesday, early reads from retail and software. Finalize entries, exits, and risk limits for Wednesday. Wednesday, PCE and GDP at the open. Let price absorb the news. Nvidia after the close. Avoid impulsive after-hours trades. Thursday, assess reaction to Nvidia and Marvel. Look for AI follow-through and leadership breadth. Friday, Kevin Warsh at Jackson Hole. Monitor the dollar and treasury yields. Trim risk into the weekend. For earnings options, use a strict checklist. 1. Confirm exact date and time. 2. Is it pre-market or post-close? 3. Know the market implied move via the at-the-money straddle. 4. Set a hard max loss. 5. Choose expiration to balance time and decay. 6. Keep size small. 7. Understand IV crush. 8. Plan profit taking and loss cutting before entry. Trade the reaction, not the headline. Price action reflects institutional capital. Do not argue with the tape. If the market contradicts your thesis, adapt. All trading involves substantial risk. This is educational, not advice.